Well, good morning. It's Monday morning, and we're here at the Red Shoe Business Club, and we're going to be wrapping up. Uh, this is the final week of the Red Shoe Business Club daily broadcasts. I hope you found them worthwhile. I've actually taught myself a few things because, as I've discussed items with you over these last 5 weeks, um, connections have happened in my mind, and I hope the same kind of thing has happened to you. I'm Mike Wright with Tax Right, the sponsor of the Red Shoe Business Club, and I'm glad you're here to join me today. I had some technical difficulties last week. It wasn't so much technical as it was locational. I was out of the office, thought I could broadcast from that location, and it turned out I could not. And by the time I was able to get back to the office, it was already too late. So I apologize for that, but we're going to pick up where we left off. We've been talking about deductions, the things that you can take off of your income and not count it as taxable income. And not to go into it too much in depth, but to remind you that you are only obligated to pay taxes on the profits from your business. And so what we're looking for are all of the things that you can effectively and legally deduct from your business revenue as expenses and thereby reduce your amount of profit. We spent several days last week talking about depreciation because that's an important feature. And for many people whose businesses involve real estate as a business deduction, depreciation is very important. But for those that aren't actually in business, but are investors in real estate, they also get to take advantage of the depreciation deduction before they calculate their profits in that investment. So there are lots of things that go on that involve depreciation, and that's why it was important to spend so much time talking about it. Today, we're going to shift gears. And we're going to start talking about some other odds and ends about expenses. I do want to remind you, the one thing you want to remember to do is to deduct all of your ordinary and necessary expenses. All of your expenses that are ordinary and necessary. Well, one of the most common expenses that businesses have is travel. And I want to start out talking about day-to-day travel. And that brings us to mileage. If you drive in your business on a regular basis, you're entitled to deduct the cost of that driving in one of two ways. The first way is actual expenses. Actual expenses are the actual amounts that you are out of pocket for the operation of the vehicle or vehicles that you're driving. This includes gasoline, oil, tires, repairs, the cost of the vehicle. Now, the cost of the vehicle, if you pay for it in cash, would still be something that you would have to depreciate over time. And if you'll recall the discussions we had last week about depreciation, that could mean perhaps a Section 179 deduction. It could also mean a depreciation over 5 years following one of the techniques of accelerated depreciation. Actual expenses allows you to take off that depreciable amount each year. The other way that you can deduct the cost of a vehicle is by mileage. Now look, you have to be able to identify how much of the use of the vehicle is business and how much is personal. And so in every case, you have to use some kind of mileage calculation. You have to know how many miles you drove the vehicle for personal or business use. You also have to consider the possibility that if the vehicle is one that is used 100% for business use, that must be justifiable not only for the actual use that the vehicle is put to, but also for the kinds of operation that go along with that kind of vehicle. And here's what I mean. If you're driving a pickup truck for your construction company, it's possible, in fact, it's even likely that in that pickup truck, you will stop and you will do personal business in that truck. Because of that, it's quite possible that there will be personal miles that you have to account for in that truck, even though it's used 70, 80, 90% or more for business. However, if you're driving a dump truck, it's much, much, much less likely that there'd be any personal use for it. In fact, I would say it would be very easy to justify 100% business use for that dump truck, even if you're operating it on the highways. So it's important that you be able to identify personal versus business mileage in all cases. But you can also use that to calculate the percentage of the actual expenses that are attributable to business, or you can use the other method, and that is to use the standard mileage deduction, which is currently $0.65 per mile. For every mile that you drive for business, you can deduct 65.5 cents. That means if you drive 100 miles, you have a $65.50 deduction built into that driving. Now, that must take into account all of the expenses you have for that vehicle, the registration, the cost, the purchase price, the repairs, the gasoline, of course. All of those things are included there. You can, however, separately write off costs for parking and costs for paying tolls at toll roads. But if you use the standard mileage allotment, all you have to do is keep track of the business miles and take off 65.5 cents per mile and deduct that from your business income. It is important, it is very important that you deduct it from your business income, because since the Tax Cuts and Jobs Act of 2017, unreimbursed personal business expenses are no longer deductible on your personal tax return. So the only way that you can get the benefit for that is to reimburse yourself at 65.5 cents a mile for the driving that you do on behalf of your business. Now, if you have 5 or more vehicles in your fleet, you must, and I underscore must, use actual costs, and you cannot use the standard mileage deduction any longer. There are also some other techniques that you can use if you have a fleet of 5 or more vehicles that I won't go into here because they're somewhat technical and probably of no interest to most of the people that are listening to me here, because for most of you, it's probably the vehicle you drive every day. The standard mileage deduction can apply if your spouse it works in your business. It's also possible to use more than one vehicle taking the standard mileage deduction and still not qualify for the fleet rate because different people, you're using a different vehicle each time you keep track of that. This is a very important deduction for you to be able to take, and it applies whether you're an outside salesperson that drives 50% or more of their time to get from place to place, or whether you're simply someone who uses your personal vehicle to run errands for the business, and maybe you go out once or twice a week to go to the bank or to visit a client or whatever. As long as these trips, no matter how infrequent, are for business purposes, you're entitled to reimburse yourself the 65.5 cents per mile. That mileage rate changes periodically. For example, in 2022, the rate started at 58.5 cents a mile, and then in mid-year in July, it was raised to 62.5 cents a mile. And then again, January 1st of 2023, it was raised once more to 65.5 cents a mile. I've also seen it come down when we have periods of extremely high gas that are followed by periods of lower gasoline costs. I've seen the rate go down. So it's something you want to keep in mind, but it's something that you want to be very much aware of because of the size of that deduction. And yes, when I do taxes for folks, I do take the time in general to compare and make sure that their actual expenses, or to find out which one works better, actual expenses or mileage. And I can tell you that in all but a very few cases, the standard mileage deduction works out better for those that are eligible for it than the actual costs. So keep that in mind. Okay, we're going to talk now, after about day-to-day travel, we're going to talk about business trips. If you travel within the North American continent, and most of the islands of the Caribbean, and you call that, and you have justification for it being a business trip, you may need to make no other justification for that business trip deduction than the fact that you consider it ordinary and necessary to the operation of your business. Yes, even if you go on a cruise, provided you can justify the cost of the business use of that cruise, you can take the costs off. Few rules of thumb, however, you want to keep in mind. Any business trip that you take for business, you must spend more than 4 hours in a day to consider that day a business day and therefore take off the expenses. More than 4 hours. I don't know if any of you have attended a convention of a professional organization or some other business-related group and have ever noticed that they almost always will have one of the days after lunch, there's free time. So that allows the people to attend the convention and enjoy themselves at the golf courses or the pleasant weather or whatever it is that makes the venue special. But by making sure it's after lunch, they comply with the more than 4 hours rule that allows that day to still be a business day. There are some special rules regarding travel back and forth and your ability to book flights ahead of the actual start of the convention. And even though if they go over weekends, it's possible that you don't have to, that you can even count those days as business days because of the requirement that you get to the convention venue. So by talking to your tax advisor and making sure that you schedule the days of your trip and the days that you travel in the proper fashion, it's conceivable that you could legally write off an entire week's vacation, even though the convention itself only qualified for 2 or 3 days. Excuse me, I'm sorry. I've got it bad in the throat this morning. Spouses are also a consideration. If your spouse is also your employee, then they're just like any other employee traveling on business. But if your spouse is not your employee, you can still deduct at least part of the costs of that trip by taking your spouse along. For example, today, most hotels do not charge extra for a second room occupant. Single and double rooms are typically charged at the same rate. If that's the case and your spouse is the one that shares the room with you, then you're eligible to deduct the entire room cost, even though your spouse is the other person in the room. Similarly, if you're traveling and your spouse's meals, your spouse's airline ticket would not be considered a business expense, but that doesn't alter the fact that your entire trip could be a business expense. Likewise, if you're driving in the car with your spouse and you're taking the standard mileage rate and your spouse is along for the ride, you don't have to separate by 50% the standard mileage deduction that you take because you have to go there whether they're in the car or not. So there are a lot of things that, again, piece by piece, one item by item, you need to be aware of what you can do and what you can't do in order to be able to take the maximum amount of deductions for this kind of travel. Tomorrow, we'll pick up a little bit on travel outside the continental United States and also talk about what happens with meals. So until tomorrow, thanks for joining me.